freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here as always with Adam Penn. Adam, how you doing today?
I'm doing good. Spent morning running and doing some errands, and they say buy real estate. It's easy and it's passive cash flow and all that. Just a little bit before this call, I was carrying a fridge with someone else up a backside of flight of stairs that then I got to take all the door handles off so it would fit through the door and then get it in, and then spilled water out of the tenant's old fridge. Anyway, that's what you get when you're cheap, and decided to go do it myself this morning.
Yeah, I mean, that is like the definition of passive cash flow right there.
Yeah, super passive.
It doesn't get more passive than that. But you've got a few other projects going on too, right? You've got flipping a couple houses and
2 flips in Chico, buying an apartment building, still raising money for that oil deal, which by the time this airs, it probably will be closed out. One other thing. I just bought a fourplex. That's the one I was carrying the thing up. So kind of create a financing structure on a fourplex, which was pretty cool.
Making some passive cash flow from the application fees.
Yeah, I was never owned a long-term rental, and so we've had a handful of people apply, and I'm like, really, people pay $50? I've never rented an apartment. I've never been a renter either, and so I was talking to my girlfriend. I was like, it's crazy. People are just applying and paying $50. And she's like, yeah, that's standard. And I'm like, I would never do that.
Like, I would have been doing this a long time ago if I'd known that.
Yeah, I would have been renting rooms for ages.
Yeah. Well, good stuff. Well, hey, I'm excited about today's. You lined up a good guest for us.
Yeah, we've got Jared, who I met at a conference beginning of this year. Nice guy. We've had a handful of conversations. We kind of hit it off. He was similar age and nice guy. We're both raising some capital, so it's hard when you get to these conferences, especially if they're more passive focused. You never know who the guys are raising money and who are putting money into deals. And sometimes people do both. And he's actually sat on both sides, right? He's been a passive investor and he has raised capital too. So I'm excited to dive into it.
Very excited to do this interview. So let's dive right in. All right, Jared, welcome to the show.
Hey guys, glad to be here. Thanks for having me.
Absolutely.
So to kind of kick it off, I mean, let's start by you telling our listeners a little bit about yourself. And me and you met at a conference a little while ago, primarily focused around passive investing and IRA investing. You had an awesome shirt on that was covered in QR codes that you could scan with your contact information. So maybe tell our listeners about what brought you to that conference and what your journey is.
Okay, cool. So I'm Jared Benson with Clotine Capital. I have a debt fund. That's what I like to do. That's what I like to work with. That's the 30,000 foot level. But how I got there was kind of a longer story. I'm actually self-employed myself. My dad was self-employed, and I got into real estate when I was about 10 years ago. Really, I was just a realtor. That's what I was doing, and selling houses. And I was like, hey, I want to do other things as well. So I started trying to fix and flip stuff. But what I realized was I was not super awesome at some of the like hands-on like flipping of real estate properties. So it's a lot of work, a lot of effort. I do really good in the just traditional like real estate sales. That's where I produce most of my like income that I provide for my family. And so taking time away from that to go like mess with this cruddy house that I'm going to try and flip.
And swing a hammer on things that you're just going to break.
Well, and I wouldn't swing the hammer, so I didn't even get the savings of doing it myself. So, so then I'm like GCing it out to GCs who are always slower than they say they're going to be. There's always something else that goes wrong.
Never had that happen.
Yeah. And so thankfully, like looking back, most of those flips were when the market was rising. So I'm in the DFW market. So, 2019, 2020, 21, market was rising. Even though I was a so-so flipper, I still made some money on it. And I was not really in the passive investing game. I thought that I wanted to, keep all of my own money in my own hands. And I thought I could do best by actively managing all of my own money. And then, I had done a couple of passive investments previously. I'd done like an apartment syndication through, I don't know if y'all are familiar with like the Sumrock group out of the DFW area. So I had gotten involved in that in 2016. I had invested through them at the time. And that was really kind of it. I made the transition in careers around that time. And I was familiar with all of the syndication space, the passive investing, but I was like, I can do this better. I can flip homes. Flipping homes is not investing. It's an entirely different business. Like that's what I have to that's where you need to end up is you either flip homes as a business or you invest, and investing is not, they're not the same thing.
We have a buddy of ours, mentor Russell Gray, who's always like, house flippers call themselves real estate investors, but they're not. They just have a business where they take cash, they buy an asset, and they turn it back into cash. It's it's a churn business. There's no investment.
They may have investors they work with who are funding them, and those investors are investors because they're not out there managing it the day to day. And so on one hand, I was like, this is a lot of work. I was still making significantly more money just selling real estate. And so then 2022 came, I started like doing cash offer advertising. Like I'm going to spend $5,000 a month. And I was on Google pay-per-click, all this stuff. Wow. Bought my first house off those like leads early 22, right before the market tanked. And so that home didn't sell for as much as I thought it would, had more repairs than I expected. And I spent $50,000 to get a home that I lost $20,000 on. So I was like, you know what? Maybe I don't want to flip homes in a rough market. I'm going to go back to what I'm good at. So that's half my story. The other half is I had lots of clients that would come back to me after they bought their own home. Maybe they were doctors, maybe they were higher income earners. And they'd say, hey, Jared, I want to invest. Can you help me find a rental property? And historically, you could do that reasonably well, or when the market was lower. And where we're at, even still in today's market, you can't cash flow on a single family home in the DFW market unless you put like 50% down.
Single family properties, I think, are hard to cash flow across the board, and they have across the board issues.
Yep, I just got a cancellation notice for one of my rentals from my insurance company, and they're just saying, "Hey, we're not renewing you," because they don't want to be in DFW anymore. On top of property taxes, out in California. Yeah, so I was already moving away to passively invest my own money because I realized I could put my money with some experts in certain areas, right? So I'm a 2% owner of a title company. I have some investments in some manufacturing companies. I, have a apartment syndication that I'm in Georgia or South Carolina, somewhere over there. I probably should know that.
It's good when you don't even have to know what state the real estate's in.
But yeah, that's exactly. I am a passive investor in that business. And what I found was I had people and friends coming to me saying, hey, I want to buy a rental property because I want to invest. And the only thing they know of is the stock market or single family rentals, which is probably a familiar thought process to a lot of guys like y'all, right? And maybe some of your investors as well, is before their eyes were opened to alternatives and syndications and funds, it was the stock market and rental properties. And, then if they buy a rental property, they get made fun of at all their friends' houses for being, a slumlord. That's like a buddy who just called me a slumlord all the time. I owned 2 properties that were nicer than the first homes I lived in.
Yeah. But you were definitely a slumlord.
I was 100% a slumlord. You've got that on video, and that's going to be a clip now. So what I found was I had these people who really would better benefit from other types of investments. And I would try to, and really at the time, I wasn't raising money. I wasn't running a fund or doing anything like that. And it was just like, hey, well, like, what about this other stuff? I do some of this other stuff. You want to come to this event with me or this? And most of the time it's kind of hard to break people out of the traditional mindset. Once they're out of that mindset, then they're excited about everything, which I guess maybe is another danger for investors, right?
I think it is. And it's funny. I'll chime in really quick. And we've talked about this before on the show. It's just and I talk about this when I talk to investors. They're like, is this a good first alternative investment for me? And let's just say it's real estate, right? I'm like, I don't even know if it's alternative, right? Because if you go back 150 years, if you were to go buy some stocks in a tech company on the other side of the country or in a different country, that would be a crazy alternative compared to buying the house down the street, right? Like that was not an alternative investment. That is how wealth was generated for most of society. Yeah.
And so I have a client that they buy homes cash and they own like 45 rental properties and they're very old now and they do it all themselves. And when I look at their cash on cash return, if you take out the potential appreciation, which we're not getting in today's market, a debt fund would produce them a better cash on cash return, even when you include the tax benefits of owning single family rental property, right? And that's like, and I think I was running math at like 100% occupancy, no vacancies, no repairs.
No turnover costs,
cash flow, no turnover, all this stuff. And it's like, oh, your cash on cash is like 6 or 7% in our market, right? No, they're not the type of person who's going to make a change, right? But just that was a good process for me to go through. My heart surgeon friend, it's like, should you spend your time looking at little dinky properties you're going to cash flow $100 a month on? Like,
so I think that's an interesting. I think that's an interesting point, right? Because that comes back to like the balance, right? Because we're in kind of this risk-off market right now where, and we have a debt fund as well that we run with Aspen Funds. And that's this right now where there's not crazy appreciation. It is going to outperform, right? But then there's the flip side down the line, call it 6 years from now, 20 years from now, next year, you never know, where the market appreciation is just going to skyrocket, right? And these debt funds are going to look stupid. So instead of just
for most people, they would look stupid. Yes.
For most people, right? But it will only be in that little blimp, right? It's not going to be over the whole life of it. So I think that comes back to having kind of a balanced portfolio. So what was kind of your path from being a passive investor to now having a debt fund? And I wasn't trying to say it was a bad thing at all. I think it just comes into that like portfolio design. Every person has something different and every person has a different amount of comfort level with what they invest in, right? Because those people basically have a job running 45 properties and that's what they like, which is different than a doctor who doesn't even want to know what state his real estate's in. Yeah. So really what kind of the transition for me was I had been seeing a need that I couldn't meet for a while. And I mean, I'm not like, I only do things when I believe they're helpful, but I also don't want to be like, hey, I'm super altruistic. I don't need to benefit from anything, right? I saw a need that I wasn't able to meet. And through an investor group I'm a part of, I met a couple of guys that, they were starting to put this together and I was able to partner with them. And for me, in our industry, it's all about trust. So these were guys I'd already known a couple of years. I already knew one of the guy who actually like does the hands-on like lending of the money. He had scaled up to, flipping 50 homes a year, right? Someone who can flip 50 homes a year, it's bonkers. And what he had realized was that as much as he could scale, it was only so scalable. Yeah. And so that's where he's like, I'm going to take a step back and I'm going to start funding, 40 flippers and I'll do the loans. And so it was like, hey, this is actually a really good opportunity. Like there's lots of alternative investments that are great investments and they're typically for different investor profiles, right? My real estate business was built on trust, reliability, follow through. And so for me I call myself a little more risk averse and then I kind of compare myself to the average market and I realize I'm actually super risk tolerant. I think of myself as risk averse, but maybe it's just like, I don't gamble, right? But a debt fund secured by real estate was one of the safest things I felt like I could offer my friends and family. And so that was kind of a couple of those things all tweaked together, people I trusted, a product that I liked and felt comfortable with.
and an opportunity that made sense to, kind of start building that.
So a few of the things you just said kind of takes me to my next question. You said, hey, these were people I trusted. I've known them for a little while. It's backed by an asset I understand. Mm-hmm. When you first started investing, or even now, do you have kind of a checklist, or what did you look for, and what should passive investors in your mind look for when they're going to find that investment?
Yeah. So I'll be honest, it kind of fell in my lap and it was just the perfect thing. Like for me and the opportunity to partner with them. I wasn't actively seeking an opportunity to work with people to raise money or handle, a fund. But what would I tell investors who were looking for, investments? And I think, a lot of times people will talk about, risk versus reward, the higher rate of return, the more risk there's going to be. And, then you get people saying, oh, well, you got to balance it. You can mitigate the risk. I think in the debt fund world, or when I'm talking with potential investors or clients, I call it an income fund, right? Because that's what they're actually buying. They're buying income. And then on the back end, it is a debt fund. That holds super true in the debt fund world. The higher rate of return oftentimes is associated with less security, not no security. But less, right? And that's okay. And less secure is okay as long as you understand it. Do you want the, 18%, preferred equity cash flowing, which is kind of not really debt, but they kind of call it an income fund. So people will confuse it. Right. And then I've seen some really weird stuff. It wasn't at the event that we met at, but I went to one also in the Dallas-Fort Worth Metroplex like a week or two after we met, Adam. And there was somebody doing like micro loans in emerging markets, third world countries.
I've seen those. Those never get paid back.
And it was like, it's like you're going to get 35% on your money on a yearly basis on what they call either a debt fund or an income fund. And when, if the newbie investor walks in and say, oh, well, you have 10 and he has 35, I'm going to go to him. And
I think that's an interesting point too, because when you're at these conferences and you meet three people and they're all awesome, right? And they're all doing these things you haven't done, you start to feel like, oh, there's all these opportunities out here. Kind of like you mentioned up front, you're like, oh, everything's great. All of these things are super interesting. And you almost get this like false trust that like, oh, everyone in this room is out for my best interest, right? And there are deals in this space, even back to your comment of pref equity, that are out there to bail out their own deals that failed.
Yeah.
And there's good pref equity and there's bad pref equity, and I'd say your red flag should go up on pref equity. I've seen one that was like a good deal, but most of the time they're bailing themselves out or they're paying themselves back.
To your point, our debt fund, our income fund is primarily pref equity, and it's all on new acquisitions, right? Just increasing LTV.
Yep.
And so we're still under a 70% LTV on almost all the loans. Yep. So that's, to your point, the difference. We're not.
And you're probably not reimbursing the general partners for loans they made to the company to keep it afloat.
No. Yeah.
Yeah. One of the good ones I saw was in Texas, and I can't explain this properly, so please don't ask me, but there's a way to get some of these commercial properties, these tax abatements, where maybe like you get zero tax for like 99 years. Mm-hmm. And so one of the guys I know, he was talking about it, and I was like, it was the first time I'd heard someone mention it. And I was like, well, dude, why do you have equity to give up but you can also cash flow? Like, what's going on? And for him specifically, it was, they spent like $1 million getting their tax abatement. So they spent like all their cash, but he has equity to give up, and now they're cash flowing. So he's trying to
tax
because they don't have to pay taxes in Texas, right? So, for that specific scenario, I was like, okay, I understand it.
Makes sense.
It makes sense, and it seems reasonable. But that's not all of them.
We were just talking to another gentleman, and then we can dive into some other questions. And Dustin, if you have any, feel free. But we were talking to another gentleman, and he said, you should come into investments thinking that it's a no, right? And we've always thought, oh, it's a yes, and you got to find reasons. He said, no, it's a no, and you're searching for the yeses, right? So, no, I'm not investing in your pref equity. Oh, it's only new loans, it's only under 70. Like you start finding the reasons that you're talking yourself into it. I think that's to a certain extent a safer mindset. It was just at least an interesting way to look at it versus a lot of people looking for red flags. This guy was looking for green flags.
Yeah, I like that because I assume you guys are fairly entrepreneurial, right? One of the problems with like entrepreneurs and salespeople, not exactly the same, but there's some characteristics that they share, is like we want to do a deal. Like, so you get excited about it. And so you're trying to make it work. And that was something that a mentor of mine on single family flips taught me. Is like, Jared, you cannot try to make every deal work you see. Like you need to cut deals fast. And I think that holds true for passive investors is they need to know what they're looking for and not go in being hopeful it's good and then trying to make it work, to your point.
Yep. Yeah, 100%. I think a lot of the money you make in any deal is made on the purchase, right? Your purchase is going to dictate probably how much equity is left in the building, your initial cash returns, LTV, loan rates, all of these things are done at purchase. And if you have a mediocre purchase agreement, and I don't mean the legal document, I just mean what you're buying.
Yeah, the deal.
And then you try to go fix the deal on the back end. Oh, well, we're paying too much, but don't worry. Rents are going up. Hey, we're paying too much, but those expenses, they're going to come down. Those maintenance costs, that's never going to happen again. Right? Those things don't happen. So
you can control the purchase price. You can't control the sales price.
Yeah.
And most
Dustin,
people
you have anything you want to dive into?
Yeah, no, Jared, I'm just curious. And we've talked a lot about debt funds in general, and you've mentioned your fund. I'd like to learn a little bit more about what you do, because I think to the point here, we've all kind of talked about it. Debt funds are a little bit of the rage right now. Like you're hearing this all the time, and like private credit and all that. And the Wall Street Journal ran an article a while back about, it's not just real estate, right? It's even businesses that are taking advantage of private credits. This is all the rage, and there's a lot of benefits. But just because something calls itself a private credit fund or a debt fund does not mean they're all made the same. And there's obviously risks, and you got to watch out for those that are just trying to bail out their own deals. So I'm curious just a little bit about your fund and kind of what your all's focus is, and what you're lending on, and kind of the overall pitch to investors.
Yeah. So that was another reason. It wasn't just the guys. It was, I understand the product intimately because we're just a hard money lender. Right. And I'm always cognizant about not actually using that term with people who I'm not certain understand what I'm talking about. Because I've met some, pretty intelligent guys, attorneys, who, when I said hard money because I wasn't thinking about it, and they assumed I was lending money to businesses that were like unsecured. And it was like, what? Like, well, hang on. Where'd you get all those ideas? So, we're doing first position liens on single family residences. The max ARV after repaired value on these homes, purchase plus renovations, is 70%. And that's for an experienced investor. We're named on the hazard insurance. We require a title policy or like title work to be done with an insurance policy associated with it. It kind of depends on the state. And we're able to pay our investors 10 to 11%, depending on their investment level. And the reason we're able to do that is because the guy who runs that debt fund he's operating in Wisconsin and Alabama, where the typical, hard money lender is able to charge like 2 to 3 points and gets about a 15% interest rate on the money he's lending. Where in DFW, that's really high. DFW, when I got a loan from like my buddies who were giving me a deal, I was paying like 2 and 10. So the average in DFW is probably 3 and 12.
Yeah, I'd say something similar to that out in California.
Yeah. So I do some guys who are local, I'll say, yeah, he's charging 3 and 15. And they're like, what? But it's, and the average loan value is like 120 grand. So he's just in markets that are significantly below average, right? The ARV on the homes that he's lending on is like 190 to 230, right? So that's what allows us to do that. And I'm able to basically tell people the security that the bank has on your home that you have a loan on is the same security we have on the homes that we're lending on.
Are your investors sitting in like a pool of all these loans, or are they on individual notes?
Yeah, no, that's going to be a difference from, people lending it themselves, is they are not individually named. So the downside is there's a little bit, they don't have the hard asset in their name, right?
No,
Which some people want.
They're an owner of the LLC.
They have their interest in the hard asset, or interest in the note, really. But the plus side is that it allows us to be flexible on how long the money's held for. So if someone wants, a return of capital, we can typically give it to them in 30 to 60 days, as opposed to 6 or 8 months, depending on how long the loan takes to turn.
Makes sense.
Yeah.
Yeah. And I think it's interesting. Like, for anyone that isn't aware, like, you kind of listed through all of the things, and I'm like, okay, that's good. Okay, that's good. ARV percentage pretty low. Like, so to your point about risk, like, it's evaluating all of those things, and, as a passive investor, understanding all of that. But that for anyone that's not familiar, that's that's about as low risk as you can play in this space.
It's about as low risk. Yeah. And there's guys who they have slightly higher income funds. Like, I was at another event with a guy, he's raising on a 12% note, but it's for a second position lien to a business, right? And it's on their asset, but it's second position. So you can get first position at 10, and you can get second position at 12. Well, if you have the risk tolerance and you want the extra 2%, you can get it.
Yeah, for sure.
Most of my investors actually want the cash flow as opposed to like growth. And so they're living off their assets cash flow. And so for them, it's minimal risk, right? They're 60, 70. They really can't afford loss of capital.
Makes sense.
Yeah, makes sense. Dustin, or maybe I'll say Jared in this case, we have a question that we normally ask all of our all of our interviewees.
Guests, Adam.
Yes. Do we want to just, if you want to edit that out, you can, or just let people listen to me fumble. But Dustin, you want to kick it off?
Yeah, no, Jared, we always like to ask, we're the Wealth Independence podcast, and like the idea of independence and freedom is obviously very, very big, and it's central to like mine and Adam's worldview.
Yep.
So we always like to ask all of our guests, what did those words mean to you? Independence, freedom, and like what does that mean? How do you like see that, and sort of how do you manifest that in your daily life?
Yeah, I think I'm glad you gave me a heads up on this question, because that's like a kind of a deep one. I sat and thought about it for a few minutes. And so for me, freedom is not the traditional like retirement, right? Where I get to go do, hit golf balls, sit on the beach, do nothing all day. It's that I can choose what I do, even if I do need to work, right? So that's one of the reasons I got into, some of the roles I have as a real estate agent, right? I'm self-employed. I'm a broker. Now, I may work 40 or 50 hours a week, and I have to do those hours, but I can still choose those hours, right? That's a level of freedom that I have, not total freedom. And so I think it's time. For me, it's time freedom. And so what I am buying with my investments and with my income is time. We have a good lifestyle, but I don't even have aspirations for a jet, right? Like that's not even the goal.
Have aspirations.
I should always have, I heard someone talk about how, as a new fund manager, I was listening to this interview, and he's like, he said something about it, like not at this time or something like that. And I was like, oh, that's kind of a goofy, but really I have 3 little kids. I'm married, had my 11th anniversary last weekend.
If you have a 4th kid, you'll need a bigger jet. Just throwing that out there.
No 5-seater. So we've got 6, 4, and 2-year-old. And so really it's the time freedom is really what I'm looking for and what I think super valuable. I was kind of thinking about this, and really might be a little too deep, but like in the Bible, I think Paul's talking to like believers who, at the time, slavery was still in effect and was very different than what we have experienced in America. But he was talking about how, like, to the believers, like, you should buy your freedom if you can, so that you don't have another master, right? And so most people's master is their job. They have to work. And so if I can buy myself out of a job with, investments and hard work and money, like, that's a good thing, that I'm freeing myself from like something that controls me and allows me to do more important things than just, open doors and buy groceries. So that's kind of how I would put it in a whole lot of words.
No, that's awesome. I I think that's great. And I think that certainly resonates. The time freedom aspect certainly resonates with me. And I think I used to think that it was, the objective was to go sit on the beach somewhere and just not ever do anything. And I think for most people that doesn't make them happy, right? It might for a time.
Correct. Vacations are great. Not saying I can't relax.
Exactly. But most people enjoy being productive and doing things and doing the things that they want to do. And if you don't have that freedom, I think that's what leads to a lot of that, when you feel like you're a slave to your job, right? When you can't leave that and you can't do the things that you want to do and make an impact in the way that you want to make it. So I think it's awesome. Adam, you got any other questions?
No, I'm all good unless there's anything else you want to add, Jared.
No, man, I enjoyed it. This was great. Dustin, glad to meet you. Adam,
too.
good to see you again, man.
Yeah, I'm glad.
Jared, where can people find you? They can connect with you, learn more about you or the fun.
Man, LinkedIn's probably the best place. Just Jared Benson on LinkedIn.
Yeah, and we can probably find that link and put it down in the show notes below. So that'll be there.
We'll definitely do it.
Sounds good, man.
Awesome. Thank
you.
All
right. Thanks, Jared. All right. Well, that was great. Was excited about that one, and Jared's got some interesting perspectives on things. I don't know, Adam. Any big takeaways for you?
I think he talked. It's similar to a lot of other guests we've had, right? He talked a little bit about his due diligence, and we brought up some stuff we've learned with other people. But I think the part that was maybe most interesting to me was just hearing how he structured his fund, or the people that he's working with have structured it, and seeing his path, right? He's a successful real estate agent. He's been able to take that and build some passive incomes. It was funny to hear the part where he was like, he didn't remember what state his apartment was in. Yeah. I remember one time talking to Robert Helms, and he was telling this story of he filed his taxes, and his CPA's like, he was looking over his Schedule E, and there was a building in, I don't know, Nebraska or something. And his CPA, he calls his CPA, he's like, I don't own a building in Nebraska, right? Like, dude, you messed up. You gotta pay more attention. And the guy's like, no, you bought it in July. Like you were driving through and you saw a building in the ad, and he started to ring a bell, and he's like, oh yeah, I was driving through, I stayed at a hotel, I saw something in the newspaper, I went and looked at it, and I bought the 12-plex. Yeah. Okay, I remember. Yeah, you're right. So sometimes you just, if you get enough of it, you forget that you own some stuff.
And especially if it's passive, right? And I think that was the other big takeaway that I had. We've talked about this some. We were joking at the beginning of this episode about how passive your house flips are. Mm-hmm. I mean, that's
it was funny to hear him say too. He's like, "Oh, those house flips, they're not passive." I'm like, "Yeah, I know."
Yeah,
but they're
and
good.
So I think that's
income.
One of the things he also brought up a really interesting point that I've seen a lot. I've experienced, which is for folks like myself. If you got the corporate background, you're taught, okay, you invest in the stock market and those sorts of things. Or if you're going to do real estate, you're either flipping houses, which again is not investment, or you buy a bunch of single family rentals. And that's the path, right? Everyone just accepts that's it. So, it's a good reminder that there's this, and you brought up the fact that, the space that's now referred to as alternatives was the original investment from way back in the day.
Landlord. It was
exactly
the title.
Exactly. So I think those were all good points. And then I was happy for, I guess, all of us to kind of dive into some of the discussion about debt funds and kind of some things there, because it was like I mentioned, there's that term's getting thrown around so much, and you really have to ask the questions to figure out what a debt fund is. And I think, certainly the hard, effectively they've got a hard money lending fund, and it's a very secure position. If you're looking for a passive way to invest in real estate, and almost you're not going to have this massive upside, but at the same time you've got a decent amount of downside protection, then that's a great way to go. But you can't just say, well, okay, that's now because that's called the debt fund, I'm now going to go invest in this debt fund because I know what they are, and that's just not how it works. So really, I think for me, it's just a reminder, especially in this day and age when everybody seems like they're trying to do a debt fund, and so many are trying to do them as rescue capital. It's so important to actually, if you're considering that, or you're getting pitched one, look into it and actually understand what it is and understand the risk profile, because they are not all made the same.
Same thing when everyone was buying apartments, right? Rising tides make everything look good.
It's exactly right. Exactly right.
Awesome.
But no, I thought that was great. And again, we'll make sure that all of Jared's info is down in the release notes, and everybody can check it out and connect with him on LinkedIn. I'm sure he'd appreciate that.
Yeah.
You got anything else?
Nothing else from me.
Excellent. Well, we will we'll get on out of here for this week. We, as always, appreciate everybody listening, and we'll see you on the next one. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.